Hi everyone, it's Alex Perini here for the Summerhill Live Q&A. As I'm sure many of you are aware, the government handed down its federal budget earlier in the week, and today we just wanted to touch on some key areas that we believe are most relevant and how they may impact our clients. Now, it's important to remember that the announcements are not yet legislated, so it's very much a wait and see to see what actually gets through Parliament. We believe there are 4 areas to take note. 1, the bringing forward of the personal income tax cuts that were scheduled in 2022. We also saw some minor changes in relation to superannuation. The major takeout really was the lack of announcements and tinkering with the superannuation system, which is always good news. Number 3, there were some measures designed to encourage business investment. And finally, we'll touch on some potential implications for Australian investors. So, kicking off with the personal tax cuts. We will not get into too much detail in this video, as it's certainly been one of the more heavily publicised announcements, but there were 2 key changes. First of all, the announcement to increase the low income tax offset from $445 to $700. And secondly, they're proposing to bring forward the personal tax cuts that were meant to take effect from 2022 into this financial year, backdating it to 1 July 2020. The 19% personal income tax bracket will increase from $37,000 to $45,000. And the 32.5% personal income tax bracket will increase from $90,000 to $120,000. Now, how this could impact you: if you're earning up and over $120,000, you'll get a tax cut of about $2,500 compared to the current tax rules. And people earning between $45,000 and $90,000 will get a tax cut this year of about $1,000. Backdating these tax cuts to the start of 1 July 2020 is particularly positive, as it means the extra money will be in the bank accounts as soon as the legislation is passed and payroll software is updated. And it could potentially result in a higher tax refund for some when completing their tax return for the 2021 financial year, to take into account the higher tax withheld for the period 1 July 2020 to date. What this means is it will really reduce tax payable for most. Now, the government would like to see us understandably go out and spend that money, but what we would definitely be encouraging people to think about, if they haven't had their income negatively impacted by COVID, is to first go back to your personal goals and assess how you can use the additional cash flow to work towards your personal goals. Now, for some, that might be increasing savings for travel, for when we're eventually allowed to travel freely again. I know that I'm certainly dying to dip into my travel budget. For others, it might mean boosting savings for a home deposit or reducing debt. It could be also worth revisiting whether to invest. Now, that could be investing inside or outside superannuation for your longer-term financial independence goals. Important to also note that these measures can also assist those distributing income from a family trust to other family members. So it can meaningfully reduce tax payable for the family as a group. Now, moving on, we saw some tinkering in relation to superannuation, but nothing major. As mentioned, the positive news there was really with regards to the lack of announcements and changes. The main takeout is that for many of our clients, the superannuation and contribution strategies will remain largely unchanged, other than reviewing contribution strategies in relation to the proposed changes of the personal marginal tax cuts. What we actually did see announced was some changes to the default superannuation system. So just quickly, the way the default superannuation system works: if an employee starts with a new employer they need to elect which super fund that their employer super contributions are paid into. If they don't choose, then the employer is allowed to make contributions into the employer's default super fund. Now, the issue with that particular system is for those not overly engaged with their superannuation, every time they start a new job, if they don't make a choice in relation to superannuation, they'll end up with another account, and this can lead to holding multiple accounts, resulting in higher fees, but more importantly, the increased potential to have lost superannuation in the future. To address this issue, the government is proposing that when a person starts a new job and does not nominate a superannuation fund, employers will be required to contribute to the employee's existing superannuation account rather than the employer's default super fund. Now, it's important to remember, though, that you do have the option to join the employer's nominated fund if you wish. So, for instance, you may want to join the employer's fund, if you receive additional benefits or subsidised fees that are a bit more attractive than your current arrangements. Also, prior to the federal budget, there was a lot of noise about potential changes to the rate or potential changes to the legislated increase in the rate of superannuation guaranteed contributions. But we didn't actually see any announcements in relation to that. So we'll assume they will be continuing on. Moving on to some business taxation announcements, and there were two main ones here. Businesses that need new equipment or would like to upgrade what they already have will have a reasonable incentive to bring forward these purchases. Until June 2022, any businesses with a turnover of less than 5 billion will be able to write off the full value of eligible assets they buy for their business instead of depreciating it over a number of years. This not only directly benefits the small businesses that are investing, but some of these assets will be purchased from and serviced by other small businesses. So it will have a trickle-on effect. The second is that losses incurred to June 22 for any businesses with turnover of less than 5 billion will also be able to offset these losses against prior profits made in or after the 2019 financial year. The reason why that's important is if you've got a business that suffered losses during COVID, it will allow that eligible business to access their losses earlier, to generate a cash refund, to provide some much needed cash boost for them. Finally, would like to just quickly touch on the potential impacts of the implications of the budgets to Australian assets and investors. So some of you may be concerned about what seems to be an extraordinary amount of debt funding the budget, particularly when we hear figures in the media such as $1 trillion. It's important to note that the Reserve Bank of Australia has kept interest rates very low, and because of that, despite the big increase in government debt, the cost of servicing that debt is about a third of what's been paid at our last recession, and less than what was paid following the financial crisis. The cost of government borrowing is very low, and more broadly, it is viewed that the blowout in the budget deficit is appropriate and affordable. It is meaningfully helping the economy as it faces this crisis, and without stimulus, the short-term hit to businesses, to jobs, to incomes, and the long-term impact to Australia would be far, far greater. The downside to this is that returns from cash and term deposits will remain low for a very long time. And this impacts those living on their cash savings or holding a considerable amount of their wealth in cash. And for bonds, the surge in public debt would generally point to higher bond yields, But this is offset by low private sector borrowing and inflation. So medium-term bond returns are likely to also be quite low. For shares, the share market has responded positively so far to the announcements, and the ongoing stimulus from the government further aids the recovery, and particularly with interest rates being as low as they are, these factors are supportive of shares. For property, there are heightened short-term risks for property relating to, high unemployment, the gradual reduction to the income support and support from banks, and the hit to migration. But it's viewed that this will not have a meaningful impact on property, and the continuing government property support measures will help offset some of this. But a big question, not only for property, but for the economy in general, is really when will we see a return to migration? Now, just quickly and on a separate note, you may have noticed from Caroline's post earlier in the week that we are moving away from holding the Summerhill community on Facebook, and we'll be launching My Summerhill. So there are a few technical limitations with Facebook, and with the new My Summerhill Community App that we're launching, we'll be able to just offer more in terms of content and be able to get to know and connect with each other better. We do acknowledge that, Facebook may be easier for some, but if we do stay on Facebook, the group will really just be shaped by Facebook's limitations, which is what we don't want. With the new app, we can do exactly what is important to us, which is really to provide financial education in a similar manner to help more Australians, to give more Australians confidence and control of their money. The new app is completely private, will be ad-free, and we'll be continuing to run monthly live Q&As in the Summerhill app as well. We'll have a couple of different groups that you can consider joining. There'll be a special group for existing clients, which will provide access to additional content, and we'll post a link for our other members in the community who aren't necessarily clients to join a separate group. And you'll always have the option to upgrade that membership if you so wish. We very much look forward to seeing you all there, and we always are interested in hearing feedback on improvements, so please reach out if you do have any. We hope you found today's session useful, and if you have any questions about the budget or any topics that you'd like covered in future live Q&As, we'd love to hear from you. Please feel free to share with anyone you think might benefit. Thanks.